going on in the market.
Thank you. I'll just... I won't be a minute because the slides have... we'll have to go all the way back. You can see there's a lot of graphs. And away we go. Right. Kia ora. Hello. Good evening. How are we all doing? Good. Fantastic. Now, just before we get underway, show of hands. Who believes tenants should be allowed to have pets? By negotiation, yeah. I'll talk a little. I don't know why, but this is such a pulverising topic. But I will come on to it later on, okay? But I want to talk about where I see the future of our industry, but also renting in New Zealand. I want to show you what's happening with rents and the importance of data. And how we can use data to run our businesses and give you advice on how you can run your portfolios, or if you're looking to get into property investment, just education. I'm a big believer in education. I started an education business for the property management industry, as Jenny said, called Real IQ. I found that when I was in property management first time round, there was a lack of training and resources for property management. A lot of real estate companies focus very much on the sales side of things, and property management was an add-on. I actually think a successful real estate business should be the other way around. The focus should be on rentals because you've got a captive market of buyers and sellers there, and it's cash flow. And in times of COVID, what keeps the doors going is cash flow and rentals. So it's a great business to be in. It has its challenges. We have no 2 days are the same. And I've got half a dozen books in me that we could write about stories with Tribunal and all types of things. But it's a lot of fun. And one of the things I want to try and emphasise, particularly with our property managers, because there is a fair bit of conflict that they have to deal with, and there is a bit of pressure in this job, as there is in all jobs. But I really want to emphasise that you've got to come to work, you've got to enjoy it, you've got to have fun. And so that's very much what I'm about. I want the team to come in, I want them engaged. To me, the property managers are the number one priority, more so than the clients, because if the property managers aren't happy, it's going to rub off on the service that they deliver. Some of the things that we want to talk about is data. Now, who can name this film? Moneyball. Who said that? You're not allowed to have a prize because you work here. Well done, Pauline. There you go. Congratulations. There you go. Congratulations. You get the prize. We've got a couple of spot prizes. You've got one of them. You named the film. Right. So, that's all right. Moneyball. If you have not seen Moneyball, it's a great movie. Now, I'm not an avid fan of baseball. All right? I love my sports. I love my cricket. And I'm more a Black Caps fan than an England fan, because I've been here for so bloody long, and England are so bad at the moment, but never mind. But there's lots of things that this movie teaches you about data. And there's a scene in the movie which I actually play at some training sessions where Brad Pitt, who is a coach called Billy Beane, or he's a manager called Billy Beane. He's not the coach, he manages the Oakland A's. Now, anyone watch the programme Welcome to Wrexham? Yeah, it's brilliant, isn't it? It's absolutely love it. And this is like a team which is at the lower end of the Major League Baseball. They've got a very small budget when they're comparing against like the Boston Red Sox or the New York Yankees. And every time they develop talent, it goes to the Yankees or goes to one of the top teams in the Major League Baseball. And he's just thinking to himself, well, there's got to be a better way. We try and develop this talent and it just goes. And he comes across this guy. His name in real life, I think it was Paul DeRosta. And he's a data analyst. So this is him in real life, Billy Beane. And he's still there at the Oakland A's. And what he decided that he was going to do, he was going to look at picking a roster based on data. Wasn't based on who looks the best and who can hit the ball the furthest. It's about who can get onto first base. Right? Who can get someone out. He just built a team purely on data. The Oakland A's then went on this winning streak, a record winning streak in the NBL, never been broken before, never been done. I think they won 20 odd consecutive games. All right, they just fell short of winning the World Series. But there's lots of information in that movie that business can learn from. Sport learned a lot from what these guys did. Football, rugby, notice I call it football, not soccer, by the way. Football, rugby, cricket, basketball, all started to use information around data. Now, we're in a fortuitous position. I think that we are the third biggest landlord in the country, behind Kangaroo, Barfoot and Thompson, and I think it's us. You've got your Ray Whites and your Harcourts, but they're franchises. So one of the advantages that we have, we capture so much data. But it's great getting all this data, but what do you do with it? As an example, and this is public knowledge, you guys can access this, and it's easy to make predictions. Right? Since 1993, rents have gone up roughly, on average, 4% every single year. We've had periods where it's not changed. We've had periods recently, particularly in the provinces, when it's gone up close to 10% a year. But if you look at it over an extended period of time, you can, if I buy an investment today, and you're looking at your return and your yield at the moment, I can go, well, it's got to increase, on average, 4% per annum. Won't always do it, but over a period of time, it will. This is data you get from Tenancy Tribunal. And Tenancy Tribunal now, I mean, they could do so much more, because there's great learnings in this. But they now capture all the applications per quarter and publish the results on what the applications are based on. And we like to measure this type of stuff because it provides great training for property managers. You can see the disputes. You can go onto orders. You can read the outcomes. One thing I will say, Tenancy Tribunal, I do not believe is biased towards tenants. I believe it is inconsistent. All right? I've dealt with some fantastic adjudicators. And I've also dealt with some shockers. And I find it's like Russian roulette. You do not know what adjudicator you're going to get. All right? And in this, you can see information. I won't use the points. I'll get up here and I'll use my finger instead. But this is the quarter just gone from the 1st of July to the 30th of September 2023. And you can see the increase in applications from the same quarter the previous year. I actually think we're starting to see a bit more in terms of rent arrears as well, and applications around rent arrears. What I actually thought would happen, because you think, you know, I'm an expert, what the hell do I know? I thought we would see a lot more tenant applications come through post the 2020 amendments, because they can get name suppression. They're protected. But surprisingly, no. The data shows you, roughly, if you have 10 applications, 2 of them are going to be made by a tenant, 8 of them are going to be made by a landlord. Right? And this number of tenant applications down here has hardly changed since they started capturing records in the first quarter of 2020. You can see how many landlord applications were happening there. Why did it drop? Why did it drop so much?
There's a backload of issues.
COVID. The lockdown. So most of the applications that you see by a landlord are for what? Rent arrears. Rent arrears. About 80% of applications landlords make are predominantly, they may have additional things on there, but predominantly they are rent arrears. And here, the government implemented changes, so issuing a 14-day notice was irrelevant. because it went from 21 days for termination to 60 plus days to termination. And you saw the number of applications plummet. Surprisingly, when the lockdown finished, we didn't see it go back to the levels that it was pre-lockdown. We're only just now starting to see a trend going upwards. Not to the same extent that I thought we would, but it's a slow trend line going upwards where tenant applications haven't really changed. And I deal with this a lot in my job. We see a number of tenant applications come through, particularly when they get tenant advocates involved. And look, we're the type of company, if we do something wrong, we front up. We always have, and we always will. But more and more, we are seeing tenants, when they do make claims, they're making them for the most outrageous sums of money. And in the end, you just say to them, take us. You know, we'll see you there. All right? These are the type of applications you see. I've kind of stuffed up this graph a little bit. What you can't see at the moment, there's two ones at the bottom ones. This is your rent arrears. So you can see the rent arrears plummet in the lockdown, and then it's gradually gone up. But this green line, what's this? That's never been there before. Healthy homes. You're starting to see tenants now making applications around healthy homes. There's roughly about 200, 250 per quarter nationwide. And the tribunal, they typically don't look too good on healthy homes, particularly if it's around insulation or heating. One thing I will say, healthy homes has been an absolute bugger to manage. When it first got introduced, I was helping out a company in Wellington, Tommy's, helping them get started, and we were managing new builds that were failing on the heating standards. Now, I'm like scratching my head going, you try picking up the phone to a landlord and saying, sorry, your brand new property has just failed healthy homes. That's not an easy call to make. And what happened was, and I think the standards, good intentions, but I think they're flawed because it looks on a criteria. What I feel it should do is look on an outcome. You know, the building materials change, and if you look at it, calculations, and it's open to interpretation as well. I've seen houses. We'll do a Q&A at the end. We'll do a Q&A at the end, okay?
I would have forgotten by then, but carry on.
Yeah, okay, that's all right. We'll do a Q&A at the end. I mean, I've seen houses where different assessors have gone in, and some have passed it, and some have failed it. Same property. And that's really hard for property managers to work with. So, great intentions, which I think we could say a lot about this with Labour. Great intentions, but the delivery wasn't always quite there. Right. Now we come on to rents. And this, again, this is data. You can all download this. This is obtained from Tenancy Services. And they collect records based on bonds. All right? And so when bonds are lodged, records started in 1993. And when a bond is lodged, someone will, and they still do it this way, it's archaic how they do it, but they are gradually making changes. What basically happens, someone will go into a computer and type in the information, the number of bedrooms, the rents, the location, and that way you can track what's happening with rents. The flaw with this is that it doesn't take into account what's happening with actual tenancies, so it doesn't capture rent increases. It only captures new tenancies. Okay? You can see the only period where we've had no rent growth was the late 90s. And the consistency. The green line is all of New Zealand. The black line is Auckland. The blue line is Palmerston North. And the red line is Christchurch. And you can see, now I'm using Palmerston as an example, but I can go into any provincial region of New Zealand and you can see the curve go like this and like that, where Auckland has been relatively consistent. We're seeing a bit of a spike here recently. I think this is immigration, which is causing rents to go up. We're seeing, net increase of immigration. We've also seen bonds actually level out a little bit. They're starting to pick up again now. But all across the provinces, I would never have believed 10 years ago that rents in Palmerston North would be the same as Christchurch. Would never have believed it. But they are. They are. And you can see the impact of Christchurch. I'll come on to Christchurch in a bit more in a moment. All right? So, and in a lot of our branches, we've seen rents increase double digits. You know, we've seen poorer stock sell off and go. And in all honesty, we've sacked a few properties, because the risk is just too great for us to manage them. Because it's our name on the tenancy tribunal order. So the stock which is coming is probably better than the stock that's going off. But we are also seeing rents just gradually just increasing more and more and more at a much higher rate in the provinces. I can't go into it, but we're in the process of dealing with a very significant market rent case in Wairoa, of all places, which has made its way up to the district court. And this is around rent increases and how much you can increase rent by. But you will hear more about that once, you know, the legal proceedings around that has finished, because it has national significance. This is what's happening with bonds. Now, I just have a bit of a theory. As you can see where you've got this consistency of this line going up. Now, the dips here, what's that? It's your student market. That's your student market. So you get a dip in bonds being refunded and then bonds being lodged. All right? And you can see the increase here. And then it flatlines and levels out. Now, at the point where it starts to level out, and if I use this trend line, this tells me we've got a shortage of stock, looking at the trend line. And if you go back to the rents, you can see the rents suddenly go upwards in this manner as the bonds flatline. And if you look at it, it's roughly around about 2015, 2016. All right? We're starting to see now a little bit of an increase. There is, I mean, apparently there's about 600,000 rentals in New Zealand. I don't think anyone actually really knows. I think a lot of it is speculation. If you go onto tenancy services, there's over 400,000 bonds lodged, held with tenancy services. Now, Christchurch is... I talk about Christchurch a lot when I go around and do talks, because Christchurch is a city that I think got it right. It may have taken a bit of time. It may have taken too long. We're still waiting for a stadium. My God, they've got a very nice cricket ground. But it's fascinating to see what has happened in terms of property. And in particular rents. You can see where the earthquake was. Right here. And you can see what happens with rents. And then it flatlines. And then it actually drops. That's the rebuild. Now, what basically happened in Christchurch, Jerry Brownlee, I think, was the earthquake commissioner at the time. And he said to the council, you've got 30 years of land that you plan to release over a 30-year period. You're releasing the whole lot now so we can get on with the rebuild. People can go and do the claims and people can get on with their lives and rebuild the houses. And that's what happened. To the point where we actually had more property than what we need. And the whole point of my talk is government intervention or talks of rent controls or, you know, wealth taxes and attacking landlords. To me, it's an issue of supply demand. And you've got to make sure that you've got sufficient supply. Now, you can't build houses overnight. It takes time. Well, we get the infrastructure right, we get the market, we get building right, we get enough stock. That's how you can control rents, is what can be seen here. And Christchurch, you know, God bless Palmy, I love the place. But if someone was moving to New Zealand from overseas and they said, where do you think I should go? For the value of money that they're going to get, bang for buck and lifestyle, I would recommend Christchurch. This shows what happened between 2002 2011. Average increase, just mean increase of 5%. Then we have the earthquake, goes up to nearly 11%. Then between 2014 and 2021, it barely changes. In fact, it goes backwards if you take into account inflation. So you combine that over that period and it shows you rents increase, on average, per annum, just over 4%. Some of the stuff that we're starting to work on as a company. So we work with a company called Velocity. Some of you may have heard of it. It is a digital valuation company, and this is where the concept of data comes into play. We're working on something pretty exciting which will be launched in 2024. So what Velocity does, it captures every single rent payment made into a software which is called Pallett's. Now, Pallett's has about a 70 to 80% market share of the property management industry. The property management industry is managing roughly about 50% of the rental market. So that means we're getting in roughly about 200,000 weekly payments are coming through their system. And that enables us to be able to capture actual live market rents. So what we will be launching next year is a landlord dashboard, which will be pretty cool. It'll show you the rent you're getting compared to what the market rent is for your actual property. We load the data of the property into Pallett's, so it captures the age, building materials, the size. It gives you an automatic valuation of what that property is worth. It has about a 10 to 15% margin of error. Same with the rents, and it shows you the difference. So you can see here, I've blocked out the address, the street numbers, but we are 5.47% behind what the actual market rent is. Now, this is why I don't want property managers necessarily making the decision on what the rent should be. It should be you guys. And we give you the information so you know exactly what's happening with the market and where market rent sits. Therefore, you're in a better position to make that decision. All right? And that's using data. I also believe what we're going to see something like this introduced in time. This is an energy performance certification. This is quite prominent in the UK and in Europe. And I think personally, I know it's got its flaws over there, it's not perfect, but I actually think this is better than Healthy Homes because it's based on the measurements and the performance of a property rather than of a criteria. And there's no time frame with Healthy Homes. You may have had your Healthy Homes house pass 3-4 years ago, but how long is that certificate valid for? Is it 5 years? Is it 10 years? No one knows. Open to interpretation, and that's what the flaws with Healthy Homes. So we may see something similar coming here. This was introduced in 2018. Now in the UK, any grading below an E, it needed to improve. So if it was an F or a G, you couldn't rent it out. Now the risk with things like this, you may end up having ghost houses, where landlords are looking at it going, you know what, I can't be asked investing the money to get a tenant. I'm land banking. At some point I'm going to demo it, and it takes a house out of the market. And there's concerns about this in the UK. What they're talking about, though, it's going to increase to C. And this is where there's real risk of people going, this is just going to get too much. And they've got a shortage of houses in the UK. My daughter lives there now in Manchester, and she rents out. And you can see that rents have increased significantly in the UK as well. So this will take effect from the 1st of April 2025. I can see a day where we get something similar to something like this happening in New Zealand. Now, we did a survey of landlords. We had an intern, young lad, Fawez, from Mass University, and he did he's done a tenant survey as well. It's really good data. And we got close to 400 landlords who did this survey. And one of the questions we asked was, would you be interested in knowing the emission rate of your investment property? I do not lie in bed at night suffering from climate anxiety. Okay? But I can just see where we are going. So what I'm trying to do is future-proof our business so we're ready for what comes ahead. Interestingly, well, it's not interesting. I mean, it's probably quite predictable. The people who are interested in knowing what the emissions are are under 40. But once you get older and older and older, and the landlords we got over 70, they couldn't give a rat's ass. Well, in 20 years' time, it's highly unlikely that people over the age of 70 are going to be clients. These people will. So I have to look to the future. And a subsidiary company to Velocity, it's the same, run by the same people as a company called Generate Zero. And we're in the process, and again, this is going to be on the landlord dashboard. We are in the process, and we're getting estimates already of measuring the emissions of the entire 7,500 plus properties that we manage nationwide. And our aim is to reduce the emissions. How we will end up doing this is that because there's got to be something in it for the landlord, because they're not living in the property. The theory I have is that a lower emission property would probably be worth more. It will probably generate a bit more rent, and it will have a higher capital value. And we're not going to make landlords do this. I'm not a Greta Thunberg, and I'm not going to paint myself or glue myself to a road anywhere soon. I guarantee you that. But we want to give landlords the options where they can actually apply for a green loan at, say, 1% to get double glazing or solar panels. And we'll work with tradies who will be able to offer and give estimates as to what they're going to be. Pretty cool stuff. Other things to look at. Regulation of the property management industry, which we think is a good thing. Compulsory training, registration, a little bit like the real estate industry. I think it's actually 50-50 whether that's going to happen. Because you've got a government with National Act, an act about culling a number of government jobs. And this would be more investment into the state. So I think it's a toss of a coin whether it's going to happen or not. I actually think a good idea will be, though, to have a landlord register so we know exactly how every property is used in New Zealand. Because what I think we could see if regulation does happen, property management companies like ours, we will not touch poor properties. And it could create a black market of poor rentals. They've said that they're going to do this. They're going to reverse the 90-day termination, or they're going to bring it back where you can give 90 days without notice. Interest deductibility, I'm going to leave all that to Kris. As I've stated, green policies on healthy homes, pets in rentals. Now, we are seeing a trend in the tenancy tribunal, which is basically giving the green light for tenants to have pets. Because there's nothing in the Residential Tenancies Act that states about pets. And the rulings of some adjudicators nationwide is that if they have a pet and you put a no clause, pet clause on your tenancy agreement, that is an illegal clause, because you're not allowed to write clauses into your tenancy agreement that are outside the RTA. So what I think will happen is that tenants will be able to have pets, but a landlord will be able to have stipulations. I think body corporates, you'd be able to, if body corporate rules would overpower the RTA in that sense. I think there's got to be, it's got to be an interesting time to see what happens. But we've actually had a case of ourselves up in Taupo where we took a tenant to tribunal to get a ruling, and the adjudicator ruled in the tenant's favour. So, and that's not a government thing, that's a judiciary thing. Okay? We're going to do Q&A at the end with both me and Kris, so you got questions for me and Kris, but I think that is it.
Firstly, a big thank you to David and the team at our Property Brokers for having me down. David and I did a few of these a few months ago, and he kind of said, why don't we do one after the election, hopefully we have a great result. So he managed to actually pencil this date in. I'd expected by that stage that the Nats would have swarmed to victory and be halfway through the 100-day plan of pulling back all of the elite policies that we've seen put in the last few years. So unfortunately that hasn't happened yet, and we're going to have to kind of get a bit of an idea of how this government's going to look over the next few days, hopefully, and then from there we'll hopefully have some changes come through. Quick intro on myself, and thank you for the quick intro you did there. My, I suppose, little bio as I started investing around the turn of the century. It was property investment that actually kind of got me into the job that or business I'm in now. And property investment, you go back, 15, 20 years ago, was a bit like the Wild West. There wasn't much in regards to rules there. I got into property trading when I was pretty young and realised that if you gave me a hammer, I was more likely to devalue a property than add value to it. Then I realised I was much more handy with a calculator. So I started working for what was known as a non-bank lender, and we're still looking around now. And it was a really good way to learn about property finance. This was a world where we were doing up to 112% mortgages, so that you could borrow 100% for the whole property when you bought it, and they give you another 12% on top. We were doing 95% mortgages, so you put 5% in as a deposit, and you didn't have to prove any income at all. And I said for a while that if you had a pulse, I could get you money, and then I did a mortgage for an estate. So if you're dead or you I could also get you money. So that's how loose it was right kind of back then. And then we ended up in something called the global financial crisis, and I was in my mid-20s and really didn't actually know that much about property investment, and found out that when you go through a downturn, you learn a lot more about the hard times, and you learn a lot more about property investment than you do when things are going up. So ran the business, as said before, for the last 16 years. We're the main sponsor for both the Auckland and the Northern Property Investors Association, and I sit a couple of pages next door to David on a monthly basis in the New Zealand Property Investor magazine, talking on about interest rates and finance. So we're here to kind of talk about, I suppose, this market moving forward after the election, and I suppose I spent the last kind of couple of days knowing that I was coming down here thinking about what to talk about, and I'm going to probably speak about property investment but through a property finance lens. And to me, I suppose the key things I'm trying to keep an eye on in regards to how this coalition and government moves forward is the availability of credit, and I'll talk a little bit later, I suppose, about the cost of credit, because to me those are the two main factors which, through my eyes, drive a lot of basically the property market and property growth. And I suppose if we go, and look back over the last 20 years of myself as a property investor, going back to between 2000 and 2008, it was the availability of credit which really drove that property cycle. Money, as I said before, was almost so easy to get, it was out of control. And there was a part of that cycle where interest rates were actually going up at a rapid rate of knots, but because it was still so easy to get, the market kept going. Unfortunately, what we saw in the global financial crisis is the finance taps got turned off, there was no availability at all for a while, and that basically caused a lot of pain. So from I suppose, government point of view, one of the main things I'm going to be keeping an eye on is how they handle the regulatory environment. This isn't just to do with property finance or property. What we've seen is a huge amount of regulation come across all industries in the last few years, and in my opinion, far too much is not actually needed. And who's heard of the CCCFA? Anyone? The Consumer Credit Contracts Finance Act. So to give you a little story for those of you who don't know what I'm talking about, if we go back a couple of years to the back end of 21, something was rammed through, and in my opinion, this was probably what played a big part in turning the whole property market around right then. And has anyone heard of Cameron Baggery? Quite a well-known economist in the room. So Cameron, I remember telling me afterwards what happened is a whole lot of policy wonks in Wellington sat down and they thought, what we're going to do is we're going to create these rules, and it's designed to protect vulnerable borrowers. And that sounds like a fantastic idea, but what it did is it turned everyone into a vulnerable borrower. And so effectively what they did is they made it almost like there was no personal responsibility, we can't trust people to make their own decisions, and in doing so they almost turned the finance tap off. So these policy wonks, not a single person in that room had finance experience working for a bank or a lender or anything. They were just people who thought they knew better than everyone else. Something which I think we've seen a little bit coming out of Wellington in the last few years. And to give you an idea of some of the stories that we saw, suddenly anything that was a regular occurrence in regards to I suppose in most cases an expense, had to be undertaken that was going to be ongoing. So we saw situations where first home buyers have been saving diligently. So let's say they had saved $3,000 a month for the last 10 months. Suddenly what happened is that had to be included as an expense. So rather than that being seen as going towards the deposit, and it would actually stop after they bought the home, the banks were basically told, no, that person might want to keep that savings going on. They had to be put in an expense, so people were getting declined on their mortgages for saving too much money. Now, other things that happened, I remember being at an ASB training session and the person trying not to laugh because they were so embarrassed about what they were having to say. But it got so granular that they were saying that if someone had a spa pool, we were having to put in the diary notes about how much we think it would cost per week for them to run the spa pool. There were other situations, and some of the people connected to the property management side of the room may remember this, that if we go back about 3 or 4 years, the whole property management industry got told off for asking for bank statements. And this was, I think there was one rival property management firm who might have said something about KFC, I think it was at the time. And so this was a complete breach of privacy. At the same time, what the banks were told to do was get people's bank statements and go through line by line. And so we went through a stage where people would have been declined for having too much Uber Eats. So it was complete hypocrisy on this stage. So we went, this is what happens when you get people putting in regulation who don't know what they're talking about. So I still remember a situation with a guy who is CEO of a listed company. He's responsible for a $100 million budget. And my staff member going, Kris, I just can't do this conversation. You're going to have to do it. And me getting on the phone and going, mate, we've got to ask you about your $25 a month gym bill and all these kind of things. And this is just, it got completely out of control. Now, to be fair to Labor, they revoked the really granular part of that relatively quickly. But what I'm interested to see, I suppose, with the incoming government, they have basically made noises, both national and ACT, I don't know where Winston stands, about moving this back further. And I think this does, there's a lot of common sense that needs to come back to, I suppose, the overall investment environment. Now, how the coalition will work with Adrian Orr. Does everyone know who I'm talking about with Adrian Orr? If you don't, this is our current Reserve Bank Governor. Now, traditionally, the Reserve Bank and the Governor should be what I call apolitical. They shouldn't be seen to be aligned to either side of the fence. In my opinion, this has not happened over the last few years. I think this has become quite a political role. And if I can use an example, if we go back to when coming up to the 2017 election, at that stage there, the current Reserve Bank Governor was due to resign, and there was going to be a brief period where there wasn't going to be a Reserve Bank Governor. National could have basically put in, I suppose, their favourite person. What they decided to do was actually sit there and go, no, this is the wrong thing to do. We'll put in a temporary person, and then basically whoever basically wins the election can decide who they put in for the next 5 years, because it's a 5-year appointment. Either way, Labor obviously got the job, won the election in 2017. Adrian Orr was appointed. If we go back to what happened 12 months ago, it was coming up to the end of his term. David Seymour, Nicola Willis, a whole lot of people basically on the National Access side, so there's no way this guy should get reappointed. Grant Robinson signed him up for another 5 years. So a completely different way of handling it. Now, going back to what I just said, the part that's going to be interesting is to see how they work together, because I think you'll find that everyone will be professionals in the room, but there is definitely a large level of dislike behind the scenes. How that plays out will be quite interesting. David mentioned before, people like David Seymour's in favour of pulling regulation off, Adrian Orr's in favour of putting regulation on. And you've got someone who's known to have a pretty abrasive personality. I know a couple of people involved with the think tank who almost ended up in fisticuffs at the airport with them because they challenged them in the media. So it could be it could be better than a soap opera for a little while coming up. The next thing is a boring term called micro-prudential tools, but I suppose behind it's pretty important. So the two main factors we're talking about here are the loan-to-value rules that most of you will probably be aware of. So this is the percentage of the property you can borrow. If you're buying $1 million property, you put in a $200,000 deposit, you're borrowing $800,000, that's 80%. So in the last, we've pretty much just clocked over 10 years since the initial LVR rules were introduced. And to give credit to the Reserve Bank over that time, I think they've done a pretty good job. They've created financial stability, they've slowed the market down when it's needed to be, they've relaxed it basically when it needs to be sped up. I suppose the first positive news I'll give you is I think over the next 12 months we'll see that relax further. So I wouldn't be surprised, maybe by mid next year we'll see the first home buyers. At the moment, if you're a first home buyer, the rule with the banks is that they can only do 15% of their total lending with less than a 20% deposit. I think that'll be moved up to 20% because they want to bring more first home buyers into the market. If you're an investor and you're buying a second-hand property, you need to stick a 35% deposit in at the moment. I think we'll see that moved up to 70% probably by mid next year. Now, that's the good news. Wait for the bad news. The reason I think they're going to throw that at you is because we're going to see something called DDIs come in. How far that's pushed, I'm not sure. Now, debt to income, there's some parts of it which are common sense. We've used loan to value rules, which are an equity-based restriction for the last 10 years. Other countries, Ireland, England, have used debt to incomes, which are an income-based restriction. People don't go broke on equity, they go broke on income. Theoretically, your property can be miles underwater, but if you can keep paying your mortgage, you don't go broke. People go broke on cash flow. So there's some parts of that I can see the common sense. The part I don't like is that the way that it's being rammed through is it's basically, in the media, the way that it's been posed is it's been made to sound like every other country already kind of has this. What every other country doesn't do is apply it to property investment. The reason they don't apply it to property investment is in the formula you use with the debt to income, it takes into consideration a living expense. If you or I go buy another property investment, we don't take another set of living expenses in. So it shouldn't actually be used for this. But I think there's a political mechanism why Grant Robinson previously jammed it in and said use this. So I think he wanted to basically almost make it harder for property investors to buy, my personal opinion. Now, to give you an idea of, I can't say how it will look because they haven't come out with any clarity. All I can say is that if we go back a couple of years, both ASB and BNZ voluntarily for about a 8 to 9 month period actually used it. So I managed to find some slides from a presentation I did back in the back end of 21. And so this is a client there and how much it affected their ability to borrow. Now, large client, but it will give you an idea on the numbers. So this client had a household income of $366,000 and they had a chunky rental portfolio where they were earning about $1.3 million a year in rent. So big, property portfolio. On the liability side, they had about $16 million in mortgages. Everything was with ASB. But I just want to repeat the reason I'm showing this one is ASB was one of the ones who put in and they started to use a debt to income formula. The reason I put credit cards is that every other part of your debt, car loans, basically gets put into this formula as well. Now, what was happening with ASB once they put the debt to income rule in? The way they would look at it is they'd look at the annual rental income. They would scale that to 75%. They would then add on the gross annual income, which came to this 1.336 figure. The next part is that if you had your own home with them, so they had security on your own home, they would times that 1.336 figure by 7, which meant that your maximum borrowing was 9.4. If you didn't have your own home with them, they would times it by 6. Anyone remember what the borrowing this client had was? Right? So, effectively at this stage here, by the introduction of this rule, ASB would have given them $6.4 million less than they already had. Okay, now, I can't tell you anything more because it's 2 years ago and my memory's not that good, but because we had other banks that were not using DTIs, I remember at the time going, what can I actually get for this client with banks who had not started to introduce a debt to income rule? We could get on $6 million by going to other banks. So keep in mind, we're capped out around this $8 to $9 million mark with ASB. Clients got circa 16, we could get 22 mil. I know that's a massive exaggerated number, but you kind of get the general gist in regards to what they could kind of do. So this is something I'm kind of keeping an eye on at the moment. I had thought we wouldn't see it. I was hoping maybe with a change of government this could be kind of put away, but because the Reserve Bank's already got it in its toolkit, they can use it. Now something came out yesterday called the Financial Stability Report. So the Reserve Bank does this twice a year. And this is where they talk about the overall state of the financial markets, the banks, mortgage arrears. I'll show you a couple of graphs shortly. And this is where they normally would look at things like the relaxing or tightening of loan-to-value rules. And they also spoke about debt to incomes. Now, what Adrian Orr basically said yesterday is that the banks have to be ready by April next year to be able to enforce this, should the Reserve Bank decide to do so. What the Reserve Bank's looking at doing is doing consultancy in the first quarter of next year to try and decide where the settings should be. They are potentially saying they might put some form of this in around mid next year, but have very loose settings. So the settings could be 10 or 12 or something like that, because they say, well, just put them in and it doesn't affect anyone. But to me, that's like giving a child a new toy and saying they won't use it, if that makes sense. If they put it in, at some stage, they're going to start to kind of twist this lever. So just keep in mind this is happening behind the scenes. And I suppose one other point which is key here as well is Something we've seen a little bit over the last 24 months, which has obviously been a pretty tight finance market, is where you want to be careful if you've got multiple properties with one bank, even if it's two, is we've seen situations where clients might have wanted to roll interest-only loans, or we've seen situations where a client might want to go sell a property. So we've seen, I'll use that as an example. The client decide to go sell a property because they want to get their hands on cash, and what the banks are now doing is they're running you through a full application process, and if you don't meet their current criteria, they're taking all the sale proceeds. Make sense? So just keep an eye on this, because if that could be something which negatively affects you, split bank. Get your properties with different banks before, so then if you go sell your property, you get the cash rather than the bank. Does that make sense? Okay, David raised a really good point before when he was talking about construction, and I think one of the first books I ever read when I was getting into property investment was Sir Bob Jones. I love Bob Jones, and he always mentioned that the developer was almost the enemy of the investor because they increase supply. The truth is they make our cities better. We want to keep building basically houses, otherwise we end up with like social issues and all this type of stuff. In regards to the construction market, there are signs already of potentially housing market shortage coming back across all the regions in New Zealand, with the exception of Marlborough. We had building consents go make a massive dip last year. You look at every region in New Zealand last year, their populations went up. So there's that kind of as a starting point. Now this is from ANZ. If we look at this graph here, I suppose first, the light blue is basically people leaving the country, dark blue is people coming in, yellow line, I suppose, is the positive net migration. Now if we look over here, this is effectively the net permanent long-term migrants coming into the country. You can see this kind of axis down here. You can see basically kind of roughly where this is fitting. Look where Palmy is. So we had not quite, but almost twice as two Palmies come into basically New Zealand last year. Now if we're looking at basically building consents down here, look how far behind we are. So while we've had a few years of catching up, this is what tends to happen. We catch up and then we stop. And we stop for a period of time because, and this is not necessarily beating up a whole lot of developers, but because of the way our whole setup is, the whole lot of people go broke, the financing stops and everything stops, and then we repeat the process. And we've been here before and we're going through it again. BNZ's got a really good report which has come out recently called the EcoPulse report. If this interests you, I'd recommend you Google it and read it. And what they're showing at the moment is, so blue, over the last 15 years, is the rough average section price. The dark blue is the average cost to build for 180 square metre house. The yellow is the average, the median house price over that time. Now new builds are more expensive than buying a second-hand property. What we are seeing basically now though, is it's the largest gap we've had. So the gap between basically a new build and a second-hand property is getting larger and larger. Now, David mentioned before about the interest deductibility, and I think that's a pertinent point. What I noticed in my business is pre-March 21, when the interest deductibility rule came in, probably 7 to 8 of every clients we dealt with were buying second-hand property. As soon as that rule change came in, it did a complete split, because investors completely got swayed by the tax change, because it was such a big cash flow change, and so we probably went to a stage where 7 out of 10 were basically buying new builds. Now, to me, I personally think with the change in government, we're going to see a lot of people who are investors who are going to go back to what I would call the traditional old way of investing, where you buy a house, we can buy it at a bit of a discount, it needs a bit of a do-up, you can get in there and you can kind of do a few things to it, and you can kind of create some equity and you can improve the cash flow. So I think in some ways people are going to be disincentivised in some ways to basically build for a while. Does that make sense? And I can only just talk rhetorically, there's nothing scientific about this, but I try and talk to a lot of real estate agents and people in the industry. And most have noticed a big pickup in the last couple of months leading into the election, definitely since October 14. I've spoken to 2 clients who work for the kind of pretty chunky building companies, the franchise type companies in the last few days. They're still dead. So I think that there's a number of factors saying that we're going to repeat this process. And I don't quite know the answer. I think David alluded to Christchurch, where they opened up 30 years of land supply. I believe that is national policy they're going forward with, I think. So I think how they enact that's important, so we don't just keep this boom, crash process that we've now done for multiple cycles. So on to the next thing, cost of credit. I mentioned that the 2000 to 2010 was probably about availability of credit. To me, the last 10 or so years have been about the cost of credit. We came out of that period on the back end of the GFC, and I think a lot of people expected interest rates to stay high. What we saw with globalisation, what we saw with my iPhone around, as I point that out, was that with technology, is these things drove interest rates down. And right up until basically the last couple of years, we've had low interest rates. And in some ways that created its own issues, but I suppose what we've seen, if I really focus on the last 2 or 3 years with COVID, I think I'd argue interest rates have had more of an effect on the property market than anything in the last 2 or 3 years. If we kind of go back to COVID in 2020 and 2021, interest rates got driven down to the lowest official cash rate ever. Huge amount of money was printed, which was also designed to drive interest rates down. I won't get too technical here, but the Reserve Bank wanted to actually have a negative official cash rate. They'd actually given the banks a certain date they had to have all their technology in order to have that, because the banks just couldn't do that. Thankfully, that never happened, because that could have caused bigger problems. And so we saw on the back of very low interest rates, massive asset inflation. And what we've now seen since mid to late 21, of course, is we've seen the opposite. Interest rates have been hiked through the roof, and we've now basically seen asset prices in general, but houses have kind of come back a long way. And so to me, I suppose how this is handled from a policy setting point of view, from the Reserve Bank, but also in combination with the government, is going to be quite important. And that ties into inflation. And I think, I'm not a fan, of course, of the current Reserve Bank governor, but he does need people in Parliament to work with him to fight inflation. It's not just completely his job. And I think looking at the most recent election, some of the policies that were being put out weren't actually going to basically bring inflation down. They were going to probably keep it high. So we can see basically inflation dropping here. If that doesn't continue to drop, rates will stay high and they could go higher. So this is quite important. So the Reserve Bank is wanting to see pain. I know that's not a nice thing to basically hear. They want to see business failures. They want to see people losing jobs. They want to see, a lot of pain going on, because that stops people spending money. And they need that to happen for this to kind of come back into a manageable area. So to throw a few graphs at you in regards to where things are at the moment, mortgagee sales are expected to be higher than where they're at. So they have been kind of trickling along at an exceptionally low rate, and we're roughly as low as we're the lowest we've been since 2005. Crazily low, even though we feel like we've been in a bit of a recession now for the best part of a couple of years. Now, that will probably start trickling up, but before I came on tonight, I jumped on Trade Me and said, how many mortgagee sales do we have? And there's 47 listings. To give you an idea, when I go to the back end of 2008, we had 3,500 on Trade Me at that stage. 1 in every 5 sales, I think it was in December 2008, was a mortgagee sale. That's basically that's how different to the market we are now to then. Now, this is probably more important though. So that pink line, that's something the Reserve Bank is keeping a big eye on, which is our non-performing loans. Now, so if you can kind of see the end of that, what they believe, I'm not sure if I 100% agree with them, but they believe in the next 12 to 18 months it's going to probably roughly ratchet up to where the top of that blue line is. If you then slide your eyes over to roughly where that is, somewhere over here, that's probably kind of the best part of a decade ago since we've seen that be that high. So that's a lot more people losing jobs, a lot more pain to basically get there. But that's basically, they came out with that information yesterday. Now, yesterday we had the job stats come out, and there's been 15,000 more people lose their jobs in the last 3 months. And this, I suppose, is, there's a lot of people who are feeling pain, but it's not necessarily distributed kind of fairly across all people. Some people are feeling completely fine, other people are feeling a lot more pain. And again, as we look at this, we're coming off an exceptionally low unemployment rate. So while some people are losing their jobs, this is a very low rate, and so it's not necessarily going to translate for a while over to the overall economy. And going off what I just said, different businesses will feel it more. Retail, hospo, I think parts of tourism, they've been hit harder than other industries through COVID, and so they're going to be feeling it also now, because a lot of them are reliant on what I call the discretionary dollar, and if people are tightening up, this is the area they don't spend. So this is a bit of an idea on retail. And what we're looking at here is, if you look at the red line at the bottom, roughly 10% of all retail businesses are basically pretty sure they may not be there in the next 12 months. The next line, which is the yellow line, that's another 30%, who are 50-50. So 40% of all retail are feeling pretty shaky at the moment. So this is going to give you an idea that what you're going to see over the next 12 months, in my opinion, is a whole lot of bad news stories, okay? Part of what I'm trying to lead on to there is, okay, that's going to be very painful for a lot of people, but at the same time, I want to refer you to something called the CoreLogic Pain and Gain Report. And what I found very interesting in the analysis they got into with that was they dug into coming out of the GFC. And effectively what it showed is the property market came out of started moving positively about 12 months before the economy did. So I think while you're going to see a whole lot of negative stories here in regards to businesses, job failures, I think if you speak to most people in the property market, I'm not saying it's going to go gangbusters, but we're definitely seeing already a positive uptick. And so for those of you who are in a position who want to invest, there's going to be opportunities over the next 12 months. Now, what we are seeing though is the main thing with what I do as a mortgage advisor that is holding people back is not actually the interest rates themselves, but it's how the banks assess the interest rates. So if you look at the blue and pink line, that's the real 1 and 2 year rates over the last 5-6 years. But if you see all these little dots, that's what we call the bank test rates. So that's what they actually assess you on, and that's what's holding people back. So we're seeing a lot of people at the moment who are saying, we want to buy, we want to buy, we want to buy, but the assessment rates are what's kind of hurting people. So at the moment, you can go get a mortgage at, say, 7%, and you might decide to have that on an interest-only basis, so to manage your cash flow. But pretty much all the banks are doing is they're assessing you at 9, and they're going to assess all of your debtors if you're paying both principal and interest. And so the true cash flow that you feel is quite different to the banks and how they test you. So just quickly skim you through an example. Let's say you've got Joe and Mary, they're on 110k combined income. They've got a couple of rental properties with $1 million of debt. They rent those out for $1,000 a week, and they are actually paying a 1 year rate of 3.6% on an interest-only basis. Now, how a bank assessment actually looks is like this. So I managed to find an old calculator back in 2020. So they're taking both of their net income, and they're taking 75% of the rental income. And so effectively that's the $10,700 coming in a month. Then what they do is they take out living expenses, and back then they would take the $1 million debt they had, they would assess it on a principal and interest basis, and they were testing them at 6.65. So they're not paying that, remember they were paying 3.6, but through the calculator, effectively income minus expenses, they're a surplus. So they're looking good to a bank. Now, we all know that Joe and Mary's position would have changed in the last 3-4 years, but for the sake of the conversation, this is the formula now the banks are using. Now, firstly, the reason I've got an asterisk at the top there was to remind me, for those of you who are maybe finding that your bank's difficult, we're now starting to find there's big disparities in the amount of rent that the banks will take. So what happened is we've got some banks who are now taking 88% of rent, we've got some who are taking less than 70%. The reason is when some of the bank regulations came in, they were told that they had to itemise rates and insurance as expenses. Then when the interest deductibility rule came in, they said, man, we're going to have to only take 60% of rent into consideration. So the banks had no idea what to take as a percentage. So they went all over the place. So at the moment, we've got banks who are pushing their percentage back up, but they're taking rates and insurance and expenses. Does that make sense? Every bank is taking rates and insurance as an expense now, but the percentage difference that they'll take on the rents is quite marked. So high level, if we look at their position, the big changes are the rates and insurance that they included as an expense, and this test rate is now obviously significantly higher. So this is happening to a lot of clients where clients are fine, but they can't get through the bank servicing calculators. Now, a really quick kind of thing to finish is if you are wanting to get back in the market in a while and you find out that you can't get through the bank, what we're seeing is more and more clients are wanting to look at, they still want to, they found a good deal, they want to move forward, and they're trying to find a solution. And so we're seeing more people basically look at non-banks. Now, I suppose borrowing comes down to equity and loan affordability. If you can tick both of those boxes, you're always going to go through a bank. If you can't tick one of those boxes, there are non-bank solutions. So a bit of an example, this is a real example from a few months ago. We had a couple with no kids. They, obviously good household income, about 300k. Great property portfolio, about 16 mil, and they had less than 25% leverage against that with about $3.5 million in debt. they're in a great position, they want to get ready to buy. Now, this is the annoying analysis we have to do these days. I'm not expecting you to be able to read any of that, but to give you a snapshot of what we do is this. So this is, they were with about 4 banks, and this is one bank's debt they had. So what the banks do, if you can look at the loan amounts on the left, we've got loan amounts, we've got the actual interest rates they're paying. This is the loan term. So this client's in a good position who's been rolling their mortgages over interest only for the whole time they've basically had it. From a bank point of view, what they're doing is they're taking the loan amount, they're taking the interest rate in their calculator, the test rate I just spoke about. They're taking the remaining loan term and they're coming up with that. Does that make sense? So I'll run you through that again. So the client's actual loan amount is about 40k. What the banks test you on is a test rate, right? Then what they do is they put you over the remaining loan term. So in their calculator, they're going 40k over a test rate over a 9-year loan term, 2032 minus the current year. Does that make sense? That spits out this. In reality, what the client's doing is that's their loan amount, that's their interest rate, and they're paying interest only. So that's the real monthly payment they're making. Does that make sense? So for this one bank, that's what the bank's calculator said they're paying, that's what they're actually paying. Cool? Make sense? So clients basically sitting here going, we're fine, want to buy. So this is, we go back to kind of how a calculator looks. They're saying this client can't buy through a bank because they're negative 7.5k a month, because they're saying this is what they are spending on mortgage payments by the time they do all their testing. What the non-banks will do is look at actual payments. So not test rate payments, actual payments. So we've got actual payments, test rate payments. You see what I mean? And so the difference is that they can basically pass, servicing check, and they can buy. So this is the kind of stuff I referred to earlier on in regards to things like debt to incomes. This is the kind of stuff to keep an eye on behind the scenes. If a bank says no, you're going to see the non-bank market grow further. To me, it's stupid because we've seen a lot of cases in the last few years where, to me, really, really good clients should just be with a bank. They're so safe. That client is so safe, if that makes sense. They should not be at a non-bank if I'm basically sitting there, but this is, I don't control the rules. So just keep in mind, if you kind of get a no, don't feel like that's a complete no. There's going to be more and more solutions coming up there to solve those problems. That's me. Thank you.
Thanks, Kris. That was a lot of information. So, has anybody got any questions for these two people? Gary had one.
Yes, I have a question. First of all, guys, great presentations. I thoroughly enjoyed that.
Thank you.
Opened my mind to a few things that I wasn't thinking about. My question is, in fact, I've got 2 questions now because time's elapsed. First one is, do you think there's a big disconnect between the building code and the healthy home criteria? Like, it sounds like those guys built a brand new house that failed.
Yeah. What happened with the healthy homes? Actually, I know the lady who was involved. I think she was based down in Massey, or she was down in Otago University. God, I forget her name. Anyway, they just miscalculated on the R values, the retention values, and subsequently new builds were looking at, because a lot of these new builds are open plan, and they just, there is a disconnect. So answer to the first question, there's a real disconnect, and it's flawed. I mean, the issues I see long term is that it's almost like we've got meth testers have turned into healthy homes testers. And I'm not banging them off, absolutely not. But we've seen this industry just evolve with no qualifications, no training. And people can just go out there and I'm assessing this healthy homes and boom, 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 boom. And when you're getting 2-3 reports for one property which are different, it tells me that it's broken, it's not right. So it needs to be reassessed. Don't get me wrong, everyone deserves to live in a warm, dry home. Everybody. I don't think there's anybody in this room who would disagree with that. It does need to be looked at. And I think I'd like to see it scrapped and something new reintroduced, personally. Yeah.
Might I add a second question?
Yep.
Once again, it's about a bit of a disconnect. If I recall correctly what you said, in terms of pets, which is a huge issue, does the Unit Titles Act override the Residential Tenancies Act?
Well, I've just been emailed someone who's that same question today because I do write a couple of blogs for different things, and I believe the Unit Titles Act will. It's not been tested yet. The thing is, and sometimes you have to explain to people who don't always understand how tribunal and the judiciary works, which is separate to government. I'm sure that they have conversations, until we see someone test it in a tribunal, we may not know, because that can set a precedent. But I would believe that if a body corporate rules, the Unit Titles Act, as your rules say you can't have pets, I reckon that would overrule the RTA, but I can't give you a definitive yes or no answer. It's just an opinion.
I think we're around pets too. None of them are allowed to put it in a tenancy agreement. If you do, 98% of the people think, well, I can't do it, so they won't. But yeah, I've been to tribunal myself with somebody who got pets without consent. A very aggressive dog that was scaring the neighbours and the neighbourhood kids. We went to tribunal. They said the dog hadn't caused any damage to the property before they could continue to keep it, even though the tenancy agreement clearly stated no pets.
Then it's antisocial behaviour. I'll go on that. One of the things that I'll say to landlords, don't say to property managers, I'll agree to a pet, but it's got to be outdoor. It's impossible to police. Yeah, it's impossible to police. So you either allow them to have pets or don't allow them to have pets.
Any other questions?
Kris, the non-bank lenders, or Secretary of Finances, or whoever you work with, they don't go through things as rigorously as banks do they, line by line, and KFCs and coffees and things?
No, and that's the part where they're seeing a big opportunity. So if I refer back to the triple CFA, all the banks basically shut up shop. But what a lot of the non-banks started looking at was the commercial market. So there's a lot of the non-banks now are going, can we make a commercial product for residential? If that makes sense, because are there any commercial investors in the room? Stuff like that, yeah. So the rules are completely different. Like the commercial market, you can still do creative stuff. It's not as regulated. They haven't completely stopped you having any fun. You can actually still do deals, if it makes sense. So there's a big chunk of the non-bank market which I'm still concerned about, because when I say big, a huge amount actually get their money through the banks. So this is how dumb it is. So a huge amount of them actually are funded through Westpac. So as an example, when the loan-to-value rules come in, their loan-to-value rules drop as well. They still somehow manage to be more loose than the banks. I haven't quite figured out how they can get around the regulatory rules. But you're seeing more and more non-banks go, okay, because the concern is that, as an example, when we had a 40% deposit on residential investment property, people couldn't buy. And so they were under the same banner. So there was one company who managed to come in who was funded through an offshore bank, and so they could do whatever they want. And there's another couple of funders at the moment who are looking at that, going, okay, if the Reserve Bank tightens and brings in debt to incomes and stuff like this, it just creates another market, if that makes sense. Yeah.
Higher interest rates,
So yes, so the thing is, I suppose initially what happens, if they've got the market to themselves, they'll charge more. And then you need more competition to come in, and that drives the interest rates down, and you just go through that cycle.
Any other questions here?
There was talk of debt to income coming in January, but then there was further talk that it was coming in March. You got any update on that?
So it definitely can't come in either of those, because the banks have been given until April to get their technology in order. I think the way it's going to play out is that because of those test rates I referred to, because they're so high at the moment, debt to incomes won't actually have as much of an effect. But at some stage when the interest rates drop, those test rates will drop as well, and then debt to incomes could then actually start to hurt, if that makes sense. So when I use the example of that big client, to be fair, this is back when test rates were a lot lower, interest rates were 2.5% and stuff like that. There's no way he could borrow anything like that now.
Can you see in 6 months you're giving April as a date for the banks to get instructions? Can you see the bankers putting pressure on highly geared portfolios on downsizing?
I don't think so. So it's changed a lot. If I go back to I'll use the GFC as an example. We saw the banks be pricks. To be honest, they were a bunch of pricks. And for anyone who's been investing in the room long enough, you go back to, for example, the early 90s. They rolled people over. They were really harsh. We saw the GFC, the same thing. They were brutal on a whole lot of people. And I think what happened on the back of that is because the government did actually back them and support them, there's almost an agreement behind the scenes that they have to look after customers. So kind of going into COVID and stuff like that, I thought they were going to be really harsh. These days it's almost impossible to get mortgages sold up through a bank. So when I'm talking about those mortgage sale numbers, most of that probably will be non-banks, to be fair. The banks are terrified of looking like bad in the media these days. If you see a bank selling someone up, they've done something really, really wrong.
Yeah, just touching on, you mentioned about offshore borrowing.
Yeah.
I've got memories going back in the...
Oh, well, the money's coming in. It's not foreign currency loans.
Due to huge
currency fluctuations.
Exchange rate fluctuations.
Yeah.
The BNZ, for one example, got into quite difficulties with some of the customers, or their customers got into difficulties with the BNZ.
Yeah, so a lot of the banks...
Because they were doing offshore contracts.
Yeah.
And when you had a fluctuation from 70 cents US to 39, it meant that you owed the offshore.
Yeah, so I haven't explained that well. So what I'm talking about here is, for example, all your banks here still get money in from offshore, but they carry the hedging risk, if you know what I'm saying. They don't pass the hedging risk on to the client. So the non-banks I'm referring to here are going to do the same thing. They'll wear the hedging costs and the rates that they basically charge you. You've got no currency risk. I don't think I've seen anyone try and have a go at foreign currency mortgages since before the GFC. Because the banks lost a lot of money. They screwed over a lot of farmers in particular doing it. Yeah. So I can't see that coming back anytime shortly.
Yeah.